This is going to be a review over July the 14th, 2022. Let me just add a couple interesting things to the chart. First one is the June 30th low. It was a possible higher low double bottom on the daily chart. We had a higher low major trend reversal here. However, this is probably not enough bars down, maybe enough bars up, and more likely, this rally was probably minor, and now that you have a double bottom, you have a rally up and a two-legged pullback down, closing on its high, increase the probability that we'll test higher, but micro channel, so first look may fail. So on the open, I thought it was reasonable for the market to test these lows and see what's below it and possibly reverse up. Although I didn't obviously expect this big of a bar today. And there's the low of yesterday. So overall, we had a trend from the open, I'd really call it just a two-legged sell climax. You can call it a wedge, you can call it just a second entry buy, second failed breakout of the June 30th low, which is this blue line, second failed breakout of yesterday's low. It's an opening reversal, is really what it is. So first bar of the day, doji bar, probably buyers below, however, and probably going to fall below the June 30th low, but you may fall further than you think. So probably buyers below, but those bulls are probably using a wide stop. Big bear bar, is it always in short? Probably not. It's good enough consecutive bars, probably at least a second leg up and sellers above, but I don't know, if the bulls get a big bull bar similar to what they got here on bar 1 during bar 3, that might be enough for an opening reversal. 3 consecutive bear bars, probably sellers above, and the first low will be minor. Bulls will buy the June 30th low, scale in, so probably going to test this low and probably test here. Bull bar, but after this many bear bars, probably sideways more than straight up, so probably sellers above. Signal bar is a bear bar, so some bears will sell this high, scaling higher. And weak doji bar, it's testing the open of the day, it's a reminder that the bulls that bought are scalping out, and bears are expecting bulls to be disappointed with the bar 4 close, that it's probably going to pull back, and we may test the low close of bar 3. Low 1 short, closing on its low, probably buyers below, but the bears want a trend from the open. They want a second entry short. You can call it a breakout pullback attempt with the June 30th low, this blue line, and that's reasonable. You can call it a second entry short. Surprise bar, probably strong enough for a second leg down. It's possible the bulls get another big bull bar closing on its high, which would be a large second entry buy, two-legged pullback, and if they do, seller close, bears would be trapped, and bears would probably get out above a bull bar. Small bull bar increases the probability of a second leg down. However, it's possible the second leg is just one bar, so it could go up a little bit and go down on the next bar, and that would meet the criteria of a second leg. Outside up, so the bulls did get a second leg. Probably, the signal bar is not that big. Context is good. Some bulls will take it for a swing. Probably better to wait for more. The one thing the bulls have going for them is by the close, bears were disappointed. They'd get out back at this low close down here. Second entry short or low 1 short, doesn't really matter what you call it. Probably buyers below. We're forming a trading range, tight trading range. Looks like a two-legged pullback. So even if we fall below, probably going to reverse up. And I think we're trying to form an early low of the day. We're below major support. And typically on higher time frames, when you fall below support, it doesn't immediately reverse. If you think about the moving average, find an example like here, break below the moving average. That's not that deep, obviously, or even that's more of a better one. We went not far below the moving average, but if this was a 60-minute moving average, we would have to go further in terms of distance because it's a higher time frame. Get back to where we were. So bull bar, you can call it a micro double bottom. Again, bears disappointed getting out break even. Some bears will get out above this bar, probably going to go sideways to up. Follow through bar, but not big. The bulls want an upside breakout, but again, until there's a breakout, there is no breakout. Big outside down bar, testing up in this area. Bulls made money buying this low, scaling in lower. So if they bought this low, scaled in lower, that's a sign of trading range price action. Bulls made money on a stop entry. Another sign of trading range price action. Bulls that bought this close, maybe they scaled in lower down here. They're getting out close enough to their first entry. So profit on their second entry, small loss on their first entry. Now we have a second entry buy, and again, further testing the low close. Didn't quite reach it here. At some point, this is creating the potential for the bears to give up. And maybe the market was trying to form a wedge bottom. And if it was, it's possible that we don't get a wedge bottom, and there's enough buyers that want to buy below a new low of the day that the market doesn't get there. And if that's the case, we may get a higher low here. 3 consecutive bull bars. We had a low, you can call it a low 2 short, low 1, or wedge 1, 2, 3. Doesn't really matter. We found buyers below. Some bulls will buy above this high, betting the channel is getting pretty tight, and we may get a bull breakout above the bear flag. So something like that, and again, at this point, I think we're going to touch the moving average. I'm confident we're going to touch the moving average and probably test the open of the day. So I think it makes sense to look to buy. Big bull bar, breakout far above this high, closing above the June 30th low. Possible measuring gap and measured move up to this high. But the bulls need follow through, and we're close to the moving average. So, the bulls need to break through the moving average like this. Bear bar, disappointing. Bears made money selling the high of this bar and scalping out. But the channel down is tight. Bears haven't made money selling on a stop entry in several bars. And that's important. If bears aren't making money selling on a stop entry, that increases the probability that the bears may give up soon. You don't want to see one side. If you think about it, if stop order traders aren't making money, then the only way they're making money is limit orders. And if that's the case, it eventually will trap traders. Kind of like, find an example here. And that's typically how small pullback trends begin. Here we're rallying, but again, I know this went more of a trading range, but it's kind of that same. Now, let me find a better. Here's a good example over here. So bears, they're selling, making money, and all of a sudden this tight little area, bears sold, did make money, and we have the bars aren't even going below a bar. So from really this low down here all the way to here, the bears didn't make money on one stop entry, did make money here. And then at this point, the bears finally made money. But when you see one side not make money for so many bars, it increases the probability of more sideways to, in this case, up in that direction. And It's kind of like this. Bulls aren't making money. They finally made money here, but even if the bear is short, even if the bulls do make money, the odds are it's going to go sideways. Breakout attempt above this bear flag. Now you can call it a wedge. 1, 2, 3. Failed breakout of the moving average. Double top here. Maybe a triangle. 1, 2. Either way, again, probably going sideways. The channel's tight. And when it's tight, you have to be a little leery of, if you're looking to sell, you have two choices. You can sell with a limit order or a stop order. Stop orders aren't making money. And if stop orders are not making money, then the other choice is limit orders. And if you think about the logic, if you're looking for, you want to sell, but the market's not giving you a good stop entry, and you're looking at the limit order trade, you're thinking, gee, that doesn't look that great. I could sell here, but bears haven't made money in many bars, so if I sell up here, scaling higher, what's the chances that I get trapped, that I'm on the wrong side of the market? Well, it's greater if stop entry traders aren't making money. Big bull bar. So any trader that was selling here, they might be trapped. And now we have a bear bar. So are the bears going to say, is this a second entry short? We went up on this bar, down, up, and down. It is, and it's a wedge, but the channel down is so tight. Do you really want to take the first stop entry? Do you really want to be the first trader to make money on a stop entry since the low of the day? And what I mean by that is, realistically, you're going to go for at least 5 points. You really need to go for probably 10. So if you're selling below a stop entry, if you sold below here, you lost money. Sold below here, you lost money. So for this many bars, bears have not made money selling on a stop. That reduces the probability of shorting below this bar. Some bulls will buy this close, disappointed, scale in lower, get out, break even up here. And that's why that happened. So another bull breakout. Are our bears going to sell the close? They might, but the bears that are selling closes or selling above bars, selling this close, selling up here, they're very quick to get out. And they're recognizing that it's becoming more and more difficult to make money. So if a trader that is selling this close or scaling in, they're not going to give the market a lot of room. Bull inside bar, they're going to probably get out, maybe break even. So it's becoming more and more difficult for traders to make money selling. And if it becomes difficult with limit orders, remember, on a limit order, if you're selling on a limit order in a tight bull channel, your risk reward is bad. Because realistically, maybe you're selling this close. Your stop might be, could be all the way up here. So if you're selling here, 53, you're probably using a 10-point stop, maybe further. So if you sell at 53 and you scale in 3 or 4 points higher, it's getting really difficult to make that math work. And the reality is you're probably not going to get 1 times your risk. So if that's the case, it's becoming a difficult trade. Bull bar, and at that point, it may just make more sense to get out break even on the entire trade, which is what you saw happening here. Some bears will sell here. They may sell several points above by scaling in, or they'll just sell several points higher. They're going to get out at the low of this bar. So good for the bears. The bears are able to sell, make a little bit of money. But again, stop order bears are not making money. And then we had a give up bar. So it's possible exhaustion. It probably is exhaustion, but it's enough of a surprise. It's a breakout above the trading range here. So it's possible bull breakout of a double top. So if you think about it, it's a breakout of a double top, which leads to a measure move up. Same thing as a double bottom. So a doji. So if the bulls were so eager, if this is going to be such a strong bull breakout, you have to ask yourself, why does the follow through look like this? If the bulls were eager to buy, it would look like this. It would be rallying strongly. So if it's hesitating on the follow through bar, that means a lot of traders were not willing to buy. They were hesitant in buying, which means there's a lack of momentum. And if there's a lack of momentum, that means traders want to buy lower. So if a bull bought the close, what are they going to do when they see this? Well, they're probably willing to buy lower, but they're going to be pretty impatient and be quick to get out. It's the same thing with selling these highs. So selling here, scaling in, sure, you want the market to sell off quickly, or even this bar. Some bears will sell below this bar, and as the market goes down, once it starts to turn up just a little bit, they're going to bail out of the trade. That's why most swing trades lead to scalps. A lot of traders will take a swing, but it's the same thing here. They'll take this swing. They hope it leads to a 20-point sell-off or a 40-point sell-off, but they know it probably won't. And because of that, they'll sell. It starts to go down. They'll say, gee, this has gone down pretty quick. I'm going to start scaling out of the trade. And then when it starts to go sideways and hesitate, they start bailing out, which causes this. So what happened right there? Bulls bought, disappointed, got out break even. Some bulls may get out a little bit higher. Bears, they'll start selling, betting that we're probably going to test the breakout point. It's a trading range day. This doesn't look like good follow through. It's late in the move. They're probably going to be disappointed, which means bears will make money selling this high. Bull bar, but probably sellers somewhere above and probably test down here. Doji bar, so sellers above, bear bar, bull bar, outside down. So look what happened there. Bears are selling up here. They're disappointed from this close. Bulls are buying small dips, scalping out. Now we have a wedge, 1, 2, 3. Bulls bought this low, took profits when it went up. Some bulls and other bulls are buying at the moving average. They're just buying bounces, and if it goes down here again, they'll buy again. Now, you can call it a second entry short. You can call it whatever you want, but it looks like the bears are getting stronger. And then we have a give up bar. So we closed the gap, so it's probably exhaustion, which means we'll probably test down to here, maybe test down to here. We've got the open of the day, and I forgot to measure this, but I'm sure this was close. Let me do this more accurate. So I'm going to get rid of this. So here is the low of the day to the open of the day, projecting up, which we came really close to and sold off. So you have to wonder if we're going to test the open of the day, which we probably will. Hesitation, but probably strong enough bear breakout that we'll probably get a small second leg down. So most traders don't want to buy. Also, if you bought this low, which is reasonable to, some might pull their order when they see that. But what are you going to do if you bought this low and then you see this bar? You're thinking you're probably going to be interested in getting out break even or with a little profit, which is why when this bar turned up, it sold off. Traders use the bounce to exit longs, whether or not they bought and scaled in. Other bears will sell this close, scale in higher, betting on that right there. So they sold that close, they scaled in, they got out break even. Some bears will just sell simply higher, betting that it's going to test the close or the low before it goes up here, which it did. We fell below the low of this bar, probably will find some buyers, and instead we got a breakout. So what's one thing to notice there? Well, there's a micro channel. 1, 2, 3, 4, 5, 6. It's a 6-bar micro channel. Whenever you have a 5-bar micro channel, 6-bar micro channel, it increases the chances of trap traders. If the bulls cannot go one tick above the prior bar, that's a strong move. and that increases the chances that the first reversal up will fail, which increases the chances that you can get a give up bar, which would be something like that. So is it always in short? Probably not. It's a test of the open of the day here, and it's tested this low. So why not? So if you sell, so most traders, it's probably not an ideal sell to close bar. Bear bar, disappointment. Bear bar, sideways. Bear bar, probably going to have disappointment again. And you're at support. So while we could go a little bit lower, we may not go that much lower, 50% pullback. So the market's probably going to bounce. And if that's the case, traders will be cautious about buying. Then we got a bull bar. But again, you have a 6-bar micro channel, 7-bar bear micro channel, probably sellers above in the first reversal up is minor. However, most bears will get out of shorts above this bar. Also, it tested the low here, so it was reasonable stop entry short. Some traders would sell more higher. Maybe they sell here, somewhere in here. They sell more up here. Confident it'll come back to here, which it did. Typical of a trading range price action. And now we had a reasonable sell to close bar. Wasn't ideal, but it was a tight enough channel. The first reversal up might be minor and fail. It tested the low close and turned up. This makes it a more credible stop entry buy. However, this right here, while that's good for the bulls, it still lowers the probability slightly because the bulls had a strong entry bar and they couldn't trigger it. So what happened there? Well, some bears were desperately trying to, they sold the close, they're disappointed by this bar, so maybe they moved their orders up a couple of points trying to get filled during this bar. And then we had a big give up bar. So it's a give up bar. Is it always in long? Probably. It probably didn't ever go always in short during the sell-off, but give up bar, it's second leg up, so it's possible second leg trap. It's a strong enough surprise bar. Probably going to have at least a small second leg. However, if the bears get a big bear bar, kind of like this, closing down here, that could be a problem for the bulls and increase the chances we get a second leg down. Doji bar, not a great sell. Probably buyers below for at least second leg up, which is what happened here. Is it a buy the close bar? Maybe, but you're getting pretty close to the upper range here. So bulls buying, probably need to be able to scale in. And again, that may not be the most ideal trade. But bulls made money, so there's the second leg. Bulls got a breakout bar, a follow-through bar, and the channel up's tight, and you have a gap here. So you have to be wondering, will we get a gap here? Outside down bar, it's a, you can call it a 2 legs up. It's a double top here, but tight enough channel. First reversal down may fail. An inside bar, probably sellers up here, but again, the channel's tight. And bears probably selling somewhere up here, but then you get 3 consecutive bull bars. This is a problem if you're selling. You ideally, if you're selling, you're betting on a scalp, which is a minor reversal, and you don't want to have a deep pullback. And if it's a minor reversal and the first reversal up's probably going to fail, then traders are going to be quick to get out. So if this isn't a great stop entry short below, that means the downside's limited, which means if you're selling on a limit order, your reward's limited. And when a trader, if they sold this high, sold up here, they may be disappointed by this bar and then disappointed again that the market's not turning down. So when this happens, when it went down and started to turn up, they may give up, which is why you got a big give up bar. Strong enough bull bar, probably at least a second leg up, but better if the bulls get follow through. Follow through bar, minimum closed at the midpoint. Probably at least, again, probably by the close going a little bit higher. Late in the move, so may not go much higher. Another by the close bar, still going higher. Doji, a sign that the market may soon turn down. And whenever you get a buy the close, sell the close situation, after the fourth bar in the buy the close or fifth bar, and you get a doji bar, it's a sign that you may get a small second leg, like one or two more bars up, and then the market might reverse. It's kind of like this: sell the close, disappointment, may get a small second leg down. Or even this is a better example. So it's probably sell the close, another bear bar, but then you get the small doji. That's a warning that you may get just a small second leg down. There's the doji. Big bull bar. What do you notice about the bar? Well, the bar is big for one, and it has no tail below, no tail above. That's a sign of probably it's climactic bar, and it may be exhaustion. It probably is exhaustion. Whenever you have the best looking bull bar with no tail late in the move, that's a sign that, and the body's bigger than any of these bars, it's a sign that bulls will take profits. So they were looking to take profits after this bar. They're probably going to take profits here, and that's why this bar immediately sold off. Tight enough channel, first reversal down is probably going to be minor and go sideways, so bulls will buy, they'll scale in, confident that the market will go sideways. And strong enough bear bar, disappointing enough that the first reversal up may fail, so you may have to get a small second leg down before you rally up to here. And testing the midpoint, some bulls that bought, scaled in, are disappointed by the pullback. They'll use this bounce to get out break even at their first entry with a small profit on their second. Others who bought this close, they may be so disappointed that they just look to get out around break even on the whole trade. Buying this close wasn't ideal though, so probably better to buy this low or even buy lower. Second entry short, some bulls will exit below, betting that we get a sell-off, but minor reversal likely. Even if we sell off to the moving average, probably going to go sideways. Bear bar, but probably more sideways, and then the bulls reversed up, second entry buy. However, tight trading range, so not a great buy. It's also above the moving average. And, here, it's testing the low close. It's tight trading range. And we broke to the upside and went sideways into the close. So overall, it was a good day for the bulls. I want to look at the weekly chart for a minute. So weekly chart. Well, let me go to the daily chart before I talk about the weekly. Daily chart. I told you it's a higher low double bottom. You can call it a higher low major trend reversal. The bulls want to rally up to here and ultimately break above this. You can call it a double bottom. They want to break above the neckline and test the June highs, which is reasonable. The bulls, they need follow through. The market's got a potential to gap up tomorrow with the bull bar closing when it's high like this. The bears, they still see a breakout below a double top. This is the neckline of the double top, and they want to see a measured move down. And we have a wedge bottom on the daily chart, 1, 2, 3, and another wedge bottom, 1, 2. So the bears are hopeful that we sell off around 3,600 and get a third leg down. We probably won't, but it's a double top, and there's a reasonable chance. I do think most bears would get out above this bar, but there's a reasonable chance, 40%, that we sell off. So over tomorrow, the bulls are going to want to try to get a big bull bar, which would be a give up bar and good follow through for the bulls after this signal bar. And if they can do that, that would cause the weekly chart to close obviously above its midpoint. And looks like the open of the week is 73.50. And well, it's not that hard because today's Thursday, so Wednesday, Tuesday, Monday. So there's the open of the week. While that's far, it's possible we get back to the open of the week. Probably won't. But that's what the bulls want. Overall, it was for always in. I'll talk about that for a minute. Might be always in short, but again, probably going to go sideways. So if you're selling down here, I don't think it's ideal. Probably better to wait for a stop entry like that. But even then, I think the downside's limited. But if I do anything, maybe sell below that bar, stop up there, probably get out above this bar, and at some point, maybe bulls buy above this bar, stop somewhere down here or here, and if they get out there, in theory, they've got to buy again. If they get out here, they got to buy again. Some bulls will just hold and wait to get out if we get 2 or 3 bear bars. Strong bull bar, first down will fail, probably get out below that bar, certainly below this bar, and it's an aggressive sell. Maybe traders will sell here, but not ideal. And always in bears probably get out above this bar. Bulls probably buy above there, stop down there or here. Breakout bar, no reason to get out, no reason to get out. And a lot of bulls will take profits here, but if you are trading always in, maybe you get out a couple points, maybe 5 points below bull bar, certainly below the bear bar, or below this bar. Bulls buy again, and then they probably get out there. And that's sideways in the day. Hope this video helps.